Yes, welcome to Veranda CA. Today, as part of our amendment session, we will be discussing chapter number 9, Audit of Banks, as part of paper number 3, Advanced Auditing and Professional Ethics in your CA final. Right. So, in this chapter, there are a lot of amendments which have come in your study material published by the ICAI. So, we will be discussing those amendments in specific. Again, I reiterate, this is just an amendment session and not the session for the entire chapter. For the entire chapter, you may have to refer the earlier discussions that were published. However, this session is mainly focused on the amendments that are introduced in this chapter. Sir, before starting this chapter, how important is this chapter? This chapter is important. Definitely there will be one question, at least one question from this particular chapter, Audit of Banks. You've had this chapter in your CA inter level also, and it's also repeated in the final. Some of the portions that you've studied in inter is again repeated in final, but there are some areas which are new, which are there only at the final level. Is that clear? So, from an importance perspective, at least one question, I would say around 4 to 6 marks can be asked from this chapter, and considering the fact that there are amendments in this chapter. Okay, now when I say amendments, there are some regulatory amendments, there are some amendments which are some points which are just added in the book, so which are highlighted in the book also. So, those points, everything we will refer. Okay. So, with this background, with this understanding, let's start with the amendments. First one, the form and content of the financial statements. Every banking company is required to prepare a balance sheet and a profit and loss account in the form set out in the third schedule. Schedule 3 to the Act. Now, which Act are we talking about? We are talking about the Banking Regulation Act and not the Companies Act of 2013. It's the Banking Regulation Act of 1949 that we are talking about. So, there also it is third schedule. In Companies Act also it is third schedule. So, please don't confuse yourself. So, banking companies are required to first follow the Special Act, which is the Banking Regulation Act, and then only the Companies Act of 2013. Clear? So, set out in the third schedule to the Act or as near thereto as the circumstances admit. Form A of the third schedule to the Banking Regulation Act contains the balance sheet, and Form B contains the profit and loss account. Every banking company additionally needs to comply with the disclosures requirement under the various accounting standards as specified under Section 133 of the Companies Act 2013, read with Rule 7 of the Companies Account Rules of 2014 insofar as they apply to banking companies or the accounting standards issued by the ICAI. Now, this is very important. It may be noted that the implementation of Indian accounting standard has been deferred by RBI for all scheduled commercial banks presently. NDAS is not applicable for all the banks. For NBFC, yes, but for banking companies, no. Now, it is very important to note that banking companies that will be applicable. There are certain banks that are not companies. For them, it is not applicable. Of course, that's a very obvious. So, you have to first follow the Special Act, and then you have to follow the the other disclosures given under the Companies Act. So, that is very important. The form and content of the financial statement will be as per the Banking Regulation Act only. It is pertinent to state that the preparation of balance sheet of a bank usually involves preparation of a standalone financial statement and a consolidated financial statement. Obviously, preparation of standalone financial statements involve consolidation of branch accounts and incorporation of various verticals/departments of bank in case of a nationalized bank or a public sector bank. The detailed procedures in this regard may vary from bank to bank. In case of private bank, the process of accounting are centralized and there is no concept of mandatory branch audit in accordance with the RBI guidelines. Public sector banks and private banks are listed on the recognized stock exchange are required to comply with the SEBI regulation, including LODR. So, of course, so a banking company is a special type of a company, right? It's not a usual company. They have a lot of public interest and public funds involved. So, therefore, any company, any economy progress can be measured by its banking system. So, the better its banking system is, you can say the economy is performing well. So, therefore, banks are the bloodline or the backbone of the economy. So, there are multiple multiple acts that apply to the bank. One, you have of course the RBI, which is a central regulator, which is a regulator for all the, it is the banker for all the banks. Yes, it's a central regulator. Then you have the Companies Act. If it's a banking company, then Companies Act will also apply. If it's a listed company, which most of the banks are listed, then the SEBI regulations will also apply. That is the LODR regulation, which is part of your chapter 7 corporate governance and audit committee. That will also apply. Okay, apart from that, there are many other regulations which will apply to a bank, but these are the three predominant regulations. Of course, Income Tax Act, your GST, all of that will apply. That is normal. All the fiscal acts will apply. But from a regulation standpoint, from a legal standpoint, these are three primary acts that will apply to any banking companies. Okay, going forward. Now, there's an amendment here, there's a new additions in this, so there could be a potential question in the examination, maybe a case study, or could be a direct question in the examination. Special considerations in IT environment. Of course, IT is information technology, not income tax. Now, information technology from a bank perspective, generally itself it's a very important. You have a specific chapter in your books in CA final as well as CA inter with respect to information technology. How information technology environment poses a risk to the auditor when he does audit. Now, everything is maintained in the ERP, everything is maintained online, your accounting software, everything is automized. So, the more the level of automation, the more there may be a risk. There may be a risk from an IT environment perspective. Okay, the banking companies are also not an exception. In fact, there are a lot of risk with as far as the bank is concerned, because most of the things are automized in a bank. Everything runs through software. Gone are the days where they used to maintain the passbook. Everything is now automized, right? Your interest calculation, depreciation, forex, everything is all automized, right? Immediately every year end or every quarter end you get the interest credits. Okay, and most of the transactions that we see, everything is all automized. So now the advent of working in CBS environment. What is CBS? It's a core banking software. I'm sure you would have heard of this term. Core, if you have studied this chapter, you will know. Core banking software environment in banks, coupled with changes in technology, use of different types, the payment systems. Of course, there are different. Now you have UPI, you have payment through Google Pay, this, that. So many things are there. So because of all, you have new different types of banks are also coming up, like your payments bank. All of this is leading to new technology, and therefore from an audit perspective it becomes very important for the auditor to assess the risks that the IT environment poses even before starting the audit, because we have to test these IT systems even before starting the audit, because we rely on the IT systems to do our audit. So therefore the first starting point for doing the audit should be the IT environment, should be to understand the IT environment. Okay, so use of different payment systems and integration of Aadhaar for cardless transactions have changed the way banking used to be in earlier times. However, the technological developments have brought new challenges for the auditors, as audit is required to be conducted through the system. Considering the importance of IT systems in preparation and presentation of financial statements, it is imperative that the bank should share detailed information with the auditors like. Now, always remember, I used to say in my class also earlier, it is very important that you go through all the point-wise questions. Wherever you have these points, right? If in the next slide also there will be multiple points, then those become very, very important, because there is a high chances that this will be asked. Now, this could be a case study, and they'll say, they can say Mr. X is the auditor of the bank. Mr. X wants to assess the IT environment. What are the information that Mr. X should ask from the bank? And this is the answer. Maybe a little bit customizable, a little bit bespoke, but you have to write, this is the framework of the answer. Right, so these are, if you know the answer, you'll be able to write, you'll be getting good marks. Otherwise, you'll not be able to do. That's the thing, right? So, what are the things that the auditor should ask from the bank, or what are the things the bank should share to the auditors as far as IT environment is concerned? Overall IT policy, structure and environment of bank's IT system, data processing and data interface under various systems. What is data interface? How one software is talking to the other software, data interface, right? Data integrity and data security, very important. How secured, what are the security controls that the bank has adopted to secure the data? Business continuity plan and disaster control plans. Tomorrow if there's a fire or if something happens to the server, what is the BCP, business continuity plan, or how is the company going to cope up with any disaster of such? I mean, anything they should have with respect to continuity of the business if there is some, some kind of an unforeseen situation that happens as far as IT is concerned. Accounting manual, critical accounting entries, their process and involvement of IT systems. Controls over key aspects, use of various account heads, expense booking, overdue identity, very important is this. How is the overdue accounts identified? How are the advances? I'm sure you would have studied about NPA, etc., right? So overdue identification, how is the banking company identifying the overdue? Is it generally through a software? It's through the ERP itself will throw up, okay, this is overdue. How is that being done? So you have to check that on a sample basis. Controls on recording of various e-banking and internet banking products and channels. MIS reports being generated and the periodicity, very important. Major exception reports. What is an exception report? Exception report could be anything, right? It could be, for example, companies' deposit accounts having a credit balance. FD generally will have a credit, I will have a debit balance, they will have a credit balance. Deposit account having a debit balance, sorry, from a bank perspective. Generally they will have a credit balance in the books of the bank. Okay, that's a money and the deposit is a liability. Any deposit account having debit balance, that's an exception. So the banker should be able to generate exception reports, right? There should be some exceptions with respect to interest rate. This FD 9% is the interest rate or 6% is the interest rate. It should calculate basis that. If it is more than that, then there should be an exception report. So there could be multiple exception report depending upon the requirement of the bank, right? Major exception reports and process of generation including embedded logic. Process of generating various information related to various disclosures in the financial statements, involvement of IT systems. Okay, so this is all what you had in your IT. So how many points, sir? There are, so even if you write some 6 to 7 points, it's more than enough. So 1, 2, 3, 4, 5, 6, 7, 8, 9 and 10 points. Sir, even if you write 6 or 7 points, if you use a catchword and do it, it will be great. I mean, if it will be very good if you can do it. Right, so this is a very important question, prior to what we discussed, very important question. Please put an into mark in your books. It could be a potential question in the examination, right? Risk-based internal audit is conducted based upon the risk assessment of business and control risk of branches. This is a separate thing. So again, I am not taking the entire chapter. I am just taking the amendments here and there. The underlying assumption under which I am operating is that you have already gone through this chapter and you already studied this chapter 1. So that so I am not going to go in depth and explain the entire chapter. It's only the amendments that I am taking here, right? So risk-based, now the next amendment is on internal audit and inspection. So now there's something called risk-based internal audit. More risk, more you have to do procedure, same process. So there is a concept of risk-based internal audit. So which area in the company, the bank has a risk, advances, deposits, interest. So you basis that will pick the area and then we'll do audit there. So risk-based internal audit is conducted based upon the risk assessment of business and control risk of branches. The risk assessment process includes identification. So it's very simple, whatever we discuss: identification, assessment, making an assessment of level, and then you have, okay, that's only 3 points. Identification of inherent business risk in various activities undertaken by the branch, that is the business risk, control risk. Okay, so we in general audit terms, we've already know that there are two kinds. Business risk we don't study in audit terms. Okay, we study there is a risk of material misstatement is equal to inherent risk into control risk, right? So first one is the identification of the inherent business risk in various activities undertaken by the branch. Sir, what is an inherent risk? Something which is already there in the system, which cannot be mitigated. For example, in a bank there are multiple levels of inherent risk. When I give a loan, there's always an inherent risk of checking the credit worthiness. It's an inherent risk. Lending business always involves a risk of non-collection, that the person will not be able to pay. It could be mitigated, but it cannot be eliminated to zero. So that's an inherent risk in the bank, right? So that's a business risk. So depending upon the branch, depending upon who are the borrowers, one inherent business risk has to be identified. Assessment of effectiveness of the control system for monitoring inherent risk of business activities of the branch. So what are the controls that are put forth by the branch to control to mitigate this inherent risk, cannot be eliminated, to mitigate. That's called the control risk. So what is the business risk? Say the example, advances are the risk, non-repayment is the risk, non-collection. Then what are the controls that are put by the branch? It could be in account of, every borrower that every money loan that we give, it has to be, a creditworthiness check has to be done 100% properly. Again, if the amount is more credit control procedures will have to be done. Proper follow-up has to be done. Proper, we have to obtain the financial statements on a week, maybe on a financial statement or a returns on a quarterly basis. So those could be the control procedures that could be adopted. Then making an assessment of level and direction of various risk areas and assess level and direction of overall business risk and control risk. So first one is identification of the inherent risk or the business risk. Then you have the control risk, how effective your control systems are to curb or to mitigate the inherent risk or to monitor the inherent risk. And the next one is make an assessment of level and direction of various risk areas. Level and direction means how high, medium or low, right? And assess the level and direction of overall business risk, and that is point 1 and point 2. So high, medium, basically categorization of the risk. High, medium, you have a risk heat map, okay, in which you categorize the risk. High risk, low risk, and the stakeholders involved. So you do that, and then you will be able to, and then accordingly the actions can be taken by the risk management committee. Now, internal controls in certain selected areas. Now there are multiple areas here, but there's a specific amendment made to, few points were added. With respect to this. Therefore, I have included here. So internal controls in certain selected areas. So clearing means clearing a check, for example. So now in the same area, when we talk about internal controls, which we were discussing earlier, there are multiple places where there are a lot of internal what should be the internal controls with respect to advances, with respect to deposits, with respect to interest accrued, etc., etc. There are multiple points, audit procedures that are there. Okay. However, with respect to clearing, there are some additional points that are added. Therefore, I have included it here in this particular session, right? So clearing under the check truncation system, which is the CTS, implemented by the Reserve Bank of India, an electronic image of the check is transmitted to the paying branch through the clearing house. Clearing house will be your, so you place a check and then it goes through the clearing house to the other bank, right? Along with the relevant information like date on the MICR band, date of presentation, presenting bank, etc. This effectively estimates the associated cost of the movement, eliminates the associated cost of movement of physical checks, reduces the time required for their collection. Now, this point was a new point. Again, examples of internal controls in a bank. Okay, not a procedure, just this thing. So they may ask you write short notes on clearing. As direct questions. See, questions could be of any type. Okay, it could be please provide examples of internal controls in clearing section. If it's a simple straightforward question can be asked. If you don't know, you don't know. If you know, you know. So again, this is since an additional point is added, therefore I am including it, right? So through the check truncation system, now gone are the days where you present it to the bank and the bank will again physically transfer the check to the other bank through this thing, and then they will transfer it to the other bank. That's not how it works. Now you have a CTS system which is completely online and automated. You present it through the clearinghouse, it goes to the other bank, and all these important information is highlighted, and the other bank makes the payment. So this eliminates the time and the cost involved of you doing a physical delivery. As per the RBI guidelines, the branch is required to either call the customer or email him for any check received. Again, we are continuing the same thing, right? As per the RBI guidelines, the branch is required to either call the customer or email him for any check received for the amount of rupees 5 lakhs and above in respect of inward clearances. The auditor may verify the compliance on test check basis. So whether you have called or you have not called. As per the RBI guidelines, the branch is required to either call the customer or email him for any check received for the amount of 5 lakhs. This much amount is debited. So sometimes what happens, you will whenever transaction happens, okay, you will immediately get an automized call, okay, whether you have done this call or not. This is an example. So that could be, again, it's all automated. There's no one doing it, right? There's a computer call. If you accept it, press 1. If you don't accept it, press 2, and something like that. The auditor check is to check whether the signature of the drawer of the check is being verified by the staff or not, as else there will be a liability of the paying bank under all circumstances, or else there will be a liability of the paying bank under all circumstances. So now, from on a test check basis, whether whenever the banker receives a check, so whether he verifies the signature of the drawer, the person, with the signature as per the bank record, that's very important, because otherwise it will be a forgery, okay. Otherwise the banker will be held responsible. The unpaid checks received in outward clearing should be either sent to the customers at their recorded address, or the customers be informed to collect the same from the bank branch. So any bounced check, so that has to be, because there is no funds in the other person's account, then that has to be either sent to the address, or the banker has to send it to back to the address, or it has to be they have to call the customer and say, please collect it from the branch. Next, audit. Now this is on the internal controls, okay. This was the only one amendment, internal control. Now do you have, apart from that, you have a lot of verification procedures that you will have to, that are there in the book, okay. Verification of assets, verification of liabilities, what are the audit procedures. Now in that also there are some amendments here and there. Wherever there are amendments, I have brought into this particular discussion, right. First is on the cash. Carry out the physical verification of cash, including foreign currency, if any cash at ATM and cash at cash deposit machines, as close to the balance sheet date as possible. So basically, carry out the physical verification of not only the cash at the bank, but also at the ATM and any cash deposit machine similar to ATM, as close as possible to the balance sheet date. Of course, if you are doing now we are on 28 or 29 today. We are on 29 today. After 2-3, everyone will be running here and there to do stock audit, cash verification, etc., right? Balance with Reserve Bank of India. Sorry, I missed the other point. The cash balance that physically verified should be agreed with the balance shown in the cash register in the CBS. CBS is the core banking software which the bankers generally use, right? Balance with the Reserve Bank of India, very important. Verify the ledger balances. Now, we have balances with the bank. The bank has certain balances with the Reserve Bank of India, because the Reserve Bank of India is the banker's bank, right? So verify the ledger balances in each account with reference to the bank confirmation certificates and reconciliation statement as at the year end. Review the reconciliation. Now this point is the newly added point. Review the reconciliation statement, paying special attention to the following items appearing in the reconciliation statements: cash transaction remaining unresponded, revenue items requiring adjustments or write-offs, and other credit and debit entries originated in the statement provided by RBI remaining unresponded for more than 15 days. So there are entries which are not responded, for which there is no source. You're not able to trace any source. That has to be traced, that has to be checked properly by the auditor. This is a specific guideline given by the Reserve Bank of India. This was a newly added point, therefore it is very, very important. Please remember this 15 days. Clear? Again, continuing, balance with other banks. So other than Reserve Bank of one bank can have balance with other bank or other bank branches, whatever it is, right? Apart from the procedures described above in examining with the balances with the Reserve Bank of India, while reviewing the reconciliation statement, the auditor should pay particular attention to the following: examine that no debit for charges or credit for interest is outstanding, and all the items which ought to have been taken to the revenue for the year have been so taken. Examine that no check sent or received in clearing system is outstanding. Examine that all bills or outstation checks sent for collection outstanding as on the closing date have been credited subsequently. Very similar procedure that we do in general BRS also. We take the BRS, see whether all the reconciling items have been subsequently cleared or not. That is the same thing that we will have to do. Okay, this point is a newly added point. Examine large transactions in interbank accounts to ensure that no transactions have been put through for window dressing, particularly towards the close of this. So what happens, just to show that there is a balance, cash balance, or just to show that there is no cash balance, they pass huge sum of money. Okay, it will be just to kind of boost the cash or boost the bank balance. Possible, highly possible. Okay, in order to avoid all of that, because it will be done only during the year end or something. If that is the case, it's called year end irregularity, which is being corrected. Okay, if such cases have to be separately identified and should have to be reversed, right? The balances with the bank outside India should also be verified in the manner described above. These balances should be converted into the Indian currency at the exchange rates prevailing prevailing on the balance sheet date. So that's very important, as at the balance sheet date, whatever is the exchange rate. Now you can use RBI rates, you can use SBI rates, whatever it is, we'll have to use that and you have to convert it. This is standard procedure which we apply across all companies, not only for banking companies. Now the next one is advances. So we discussed on cash and bank. Now we are discussing the audit procedures on advances. In carrying out audit of advances, the auditor is primarily concerned with obtaining evidence about the following. Evaluation of, very important, is the internal control over advances. Examine area of credit appraisal and verify whether laid down procedures regarding credit appraisals, including loan application, preparation of proposals, obtaining satisfaction about credit worthiness of the borrowers, are being followed. So very important, before, if a banker starts giving loan, and that's how all the frauds happen, right? Bankers give loan without properly checking the credit worthiness of the borrower. Most of the frauds that are happening, or have happened, is because of not properly checking the credit worthiness of the borrower. So there should be absolute, internal controls over this. This is one of the most important area which every bank needs to focus on, right? Now, as the government is also becoming little more stringent, the Reserve Bank is also becoming a little more stringent with respect to this, right? Examine advances are sanctioned according to the delegated authority. Yes, so depending upon the value of the advance, the amount of the advance, the authority will also keep differing. Examining all necessary documents have been executed after sanction but before disbursals are made to the borrowers. Examine, so whatever is highlighted in bold are all new points, right? Examine compliance with stipulated terms of sanction and end use of funds, more particularly in case of term loans. So I have got the fund for a certain purpose, I have to use it for that. So most of the frauds again happen, if you've seen the Punjab National Bank case, or if you've seen the ILFS case, if you've seen the recent, there's one more case which happened in Gujarat. So all these are term loans, most of it are term loans which are taken and they were not used for the purpose for which they were, being taken, and they were diverted somewhere else. Now the bankers will have to have some kind of a check. They need to update the financial statement, get the utilization statement from the company to understand what is the end use. And also for this, there is for Caro there is banking company, the Caro is not applicable, but generally for the borrower company, of course it is applicable. So there is a Caro reporting requirement, Caro 2020, and not only that, now there is an amendment in Schedule 3. We've discussed this Schedule 3 amendment. If any term loan that have taken have not been used for the purpose for which they have taken, that has to be disclosed in the financial statements. So these two are complementing each other now. So simple a banker can do is to check the disclosures in the financials, check the Caro reporting, and he'll be able to understand, right? Examine existence, enforceability, and valuation of securities. In respect of securities requiring registration, examine this area also. Now all these are internal controls which the bankers will have to do before giving a loan. Examine the validity of the recorded documents, review operation of the account, very important, operation. So once you give a loan, then you have to keep reviewing, monitoring the operations, how it is happening, what is happening, is it completely silent, is there a repayment that is coming, right? Review operation of accounts and look for adverse features like unauthorized overdrawings beyond limit. Examine whether the system laid down in the bank for review or renewals of advances is being followed. Review whether drawing power is being calculated properly on the basis of stock or book debt statements received from the borrowers as stipulated in respective sanction letters. Again I repeat this, review whether drawing power, we all know what is the drawing power, what is the sanction limit. There is a drawing power and then there is a sanction limit. It could be 1 crore, drawing power will generally be less than that, right? Review whether drawing power is being calculated properly on the basis of stock or book debt statements received from the borrower as stipulated in respective sanction. This is very important. So the bankers need to always monitor the drawing power. So generally for current assets, for OD facilities or CC facilities, that will be given on the working capital. Now the working capital is not fixed, it will keep fluctuating, right? So suppose if there are months or quarters where the working capital has come down drastically, in those cases the bank will have to review the working capital requirement. In fact, there's again an amendment here with respect to this. There's a Schedule 3 amendment and also there's a Caro requirement of 2020 which says wherever any loans that have been given on the basis of current assets, the quarterly stock return that are being submitted to the bank should match with the books of accounts. If not, the details and discrepancies have to be disclosed in CARO as well as in Schedule 3. So previously what the borrowers used to do, they used to just to see that the proper working capital is being maintained. They used to inflate the stock. They used to make adjustments to these, to the financial statements and used to submit that to the bank. The bank also used to take it on face value. They never used to do audit properly. Check properly. Some banks may insist on, getting an audited financial statements, etc. But that may not be possible everywhere. So therefore, this has been included now. This has been included. So the bankers have to be very shrewd in seeing all of this, right? Ensure compliance with loan policy of the bank as well as prudential norms of RBI, including appropriate asset classification and provisioning. Okay, so all these are very general points. Some points have been added, therefore it's very important for you to kind of go through these points. So now, how will the question be? Question will never be straightforward. It will be like a case study, but the final question will be, please explain the audit procedures, which will be basically this, right? Substantive audit procedures. Verify correctness of master. What we first discussed is the internal controls. Now we are discussing all advances. Substantive audit procedures, right? Verify correctness of master data of loan accounts updated in CBS. Check parameters like loan installments, EMI, rate of interest, tenure loans, etc. Right, verify that each customer of the bank is tagged under single customer ID in respect of all its accounts, including those in which credit facilities are granted. So if I am a customer, I may have an OD facility, I may have a fixed deposit, I may have a, I may have a current account, savings account, so on and so on. I may have multiple facilities, but I am one single customer to the bank. So all my facilities should be under one single customer ID. I cannot have 2 or 3 multiple customer IDs. That's what is being told here, right? So if the bank opens a database in the CBS, he should know everything. That's how it should work. Examine all large advances, while other advances may be examined on a sample basis. Now, large again depends upon the criteria of the branch. Examine accounts identified to be problem accounts which have not yet slipped into the NPA category. Very, very important this is. This can be done by obtaining list of SMA and SMA 1 and SMA 2 borrowers from the bank, and same can be considered for selection of problematic accounts. So, what is the meaning of this? Is a new important point. What is an SMA account? SMA account is called a special mention account. Now, we all know the general thumb rule is, as per the RBI prudential norms, any account, OD facility or whatever it is, will become an NPA if it is overdue by more than 90 days. Yes or no? This is the thumb rule. There are specific details, but generally it is, if your account is overdue, if you have not paid your installment or whatever it is, if it is overdue by more than 90 days, then it becomes a non-performing asset, something which we all already know. However, SMA 1 and SMA 2 basically means going to become NPA. Accounts that may become likely to become NPA, then they are called special mention accounts. Okay, so they are high risk category accounts. SMA 1, SMA 2 is the most risk category account, almost going to be slipped. Well, how do you know? There are multiple factors. SMA 1 is basically overdue between 30 to 60 days, or I would say 31 to 60 days, as at the balance sheet date. Overdue between 31 to 60 days, that is SMA 1. And SMA 2 is 61 to 90 days. So these accounts you need to check, and you may want to create a provision now itself. Possible, highly possible. The auditors will, because we know for a fact this is going to become a NPA account. So these are called SMA 1 and SMA 2, almost going to get slipped. SMA 2 is the most riskiest category. Now to be slipped into NPA. Now there is also called SMA NF. Non-financial. Now, see, this is completely based on the aging, right? Overdue aging, right? This SMA 1, SMA 2. There could be accounts where it's not aged yet, but some non-financial stress indicators indicate that it will be an NPA. Then that will be classified as an SMA NF account, right? Examine those accounts which have been adversely commented upon by concurrent auditors, bankers, internal inspection, RBI inspection team, etc. Very important. Examine list. All these things you have to ask from the bank. Examine list of restructured accounts to ensure that restructure is as per the RBI guidelines. Remember, restructured account portfolio requires additional provisioning. Very important. Examine quick or early mortality accounts. Any advanced slippage to NPA within 12 months of its sanction is called as quick or early mortality account. So examine all the accounts which quickly slip to, I just got the loan, immediately it becomes an NPA. So that's a quick mortality account, right? Verify completeness and accuracy of interest being charged, right? So that's again a automated thing. So you'll have to see the logic how it is done, and on a sample basis you can test check, right? Carry out appropriate analytical procedures. So again, advances, what were the advances last year, what is the advance this year, how is the movement, what is the movement, all this you'll have to see. Now, the next part is on class. Again, we are on advances only. I am only doing the amendments, highlighted in bold are all the amendments. Classification and provisioning. Verify whether a bank has a system of ongoing identification and classification of advances. We already discussed in the IT environment earlier, there should be a proper system of loan identification, that is an NPA identification, right? Verify whether the bank has a system of ongoing identification and classification of advances through CBS without manual intervention and its accuracy in crystallizing the date of NPA, on which date it becomes an NPA, because from that date their provisioning will start. Examine whether the classification made by the branch is appropriate. Particularly examine the classification of advances where there are threats to recovery. You may want to create additional provisioning for that. You may want to classify it as a loss asset itself, right? Examine whether the secured and unsecured portion of advances have been segregated correctly and the provisions have been calculated properly, because your NPA provisioning is completely based upon secured and unsecured, at least at the early stage. Review and compare date of NPA of loan accounts mentioned in the current year statements with that of the previous year. Reasons for any change should be ascertained. Now, once classified as NPA, now you've got the recovery, now you're making it standard. Okay, that also you need to check, right? So that is on this. Account fit temporary. Now this is a completely new addition in this study material, so that's why I've taken it here. Account fit temporary deficiencies. Banks should not classify an advance account as NPA merely due to the existence of deficiencies which are temporary in nature, such as non-availability of drawing power based on the latest available stock statement, balance outstanding exceeding the limit temporarily, and non-renewal of limits on the due date. So that could be some temporary here and there deficiency which we need to understand on a case-to-case basis, and then we need to take a holistic view and ensure whether the NPA classification is appropriate or not appropriate. This is very important, right? So, however, stock statement relied upon by the bank for determining drawing power should not be older than 3 months. I said, right, every quarterly they will review the working capital and review may revise the limits, right? Downward revision, upward revision, however it is. The outstanding in the account based on the drawing power calculated from the stock statement older than 3 months are considered as irregular. Ensure adherence to these guidelines. Now, this is a completely new area. This could be a potential question in the examination. A case study can be asked from here. Just because there is a temporary deficiency doesn't mean you have to make it an NPA. This is an important area. Now, asset classification to be borrower wise and not facility wise. This is also there. Okay. So once an NPA, say I am a customer, I have say 5 loans. One of the loan has become an NPA. Whether that loan alone will be classified as NPA, answer is no. All the loans, all the credit facilities that I have from the bank will become an NPA. That is why we say asset classification is to be borrower wise and not facility wise. Okay. Not only from this branch, from all the branches of the same bank, everything becomes an NPA immediately, right? That's important. Ensure that asset classification is borrower wise and not facility wise. Therefore, it is to be ensured that all the facilities granted by the bank to the borrower will have to be treated as an NPA and not particular facility which has become irregular. Further, if debits arising out of devolvement of LC or invoke guarantees are kept in separate account, the outstanding balance should be treated as part of the borrower's principal account for purpose of application of prudential norms on asset classification, income recognition and provisioning. So, the last point is further debits arising out of devolvement of letter of credit or invoke guarantees are kept in a separate account. The outstanding balance should also be treated as part of borrower's principal account for the purpose of prudential norms, right? So, any LC facilities, any guarantees that have been invoke guarantees which are kept in separate account, that also should be considered as part of provisioning NPA. So, the point of the matter is it has to be borrower wise and not facility wise, the NPA provisioning. In respect of agricultural loans other than those specified in the circular, ensure that identification of NPA has been done on the same basis as non-agricultural advances. Okay. Now provisioning towards standard assets. So I am hoping this point is clear. In respect of agricultural loans other than those specified in the circular, ensure, so agricultural advances, there is a separate way of classifying it as an NPA, not an NPA. So if it's depending upon the crop season, long duration crop and short duration crop, if outstanding for more than one crop season, then it becomes an NPA. It's not your hardcore 90 days limit, right, for agricultural advances. So here it says, other than those specified in the RBI circular, ensure that the identification of NPA has been done on the same basis as non-agricultural advances. Other than those which are given in the circular, everything else is falling under 90 days limit only. That's what it means, right? Now, provisioning towards standard assets. The auditor should check the latest RBI circular in this regard. It is being understood that the provision for standard asset is also required that to be made at variable rates in respect of different sectors for the funded outstanding in accordance with the RBI norms as a matter of prudence. Now, we all know that NPA requires a provisioning. There could be certain provisioning that may be required for standard assets as well as per the RBI norms. Okay, so they may say for this sector this much percentage, for this sector this much percentage. So you will have to check those circulars and you will have to give the the provisioning in accordance with that. The provision needs to be checked in detail with the statement of advances, whether provision have been carried for, have been provided or not provided. The bifurcation of standard advances in the relevant category for proper calculation of provisioning should be checked and certified at branches level. The definition of respective items specified should be adhered as defined by Reserve Bank of India. Okay. Now, this could be an important question in the examination. Restructured advances. Restructuring is an act in which a lender, for economic or legal reasons relating to borrower's financial difficulty, grants concession to the borrower. So there could be a package. So 5 crores is the loan, I am not able to pay. I go and tell boss, you restructure my loan, and the banker will give some kind of concession. That exercise is called restructuring. It will differ from case to case. It may involve modification of terms of advances, including alteration of amount of installments, alteration of repayment, repayment period, rate of interest, sanction of additional credit facilities, etc. to help in curing of default. Now, how is it relevant? From a provisioning perspective, it is relevant. RBI has given revised guidelines for treatment of restructured account by its circular. The auditor should verify compliance with requirements of the circular issued in this regard. So, generally what happens when you restructure your loan, you may have classified that as an NPA, you may not have classified that as an NPA. If you have already classified it as an NPA, when you restructure it, take it back, and then if the restructured loan is again being defaulted, then it becomes an NPA again. So, banks may restructure the accounts classified under standard, substandard or doubtful categories. Banks cannot restructure accounts with retrospective effect. Of course, you have to do it prospectively only. Once the bank receives an application or proposal in respect of an account for restructuring, it implies that the account is intrinsically weak. Of course. Accordingly, during the time the account remains pending for restructuring, the auditor needs to take a view whether provision needs to be made in respect of such accounts pending for approval for restructuring. So, this is also very important. So, there is no specific guideline that is given this much percentage has to be taken. Generally, RBI norms are very straightforward. This is the amount, that's all, nothing doing. But here a judgment is involved by the auditor. The auditor needs to take a judgment. Okay, with respect to accounts pending for restructuring, when an application received, banker is yet to act upon. So, in that case, the judgment has to be taken by the auditor with respect to provisioning of the accounts. On restructuring, the accounts will be downgraded from standard to substandard. NPAs will remain in the same category. Okay, once an NPA, when that loan is restructured, you can bring it back, and then once it is kind of again defaulted, then it becomes an NPA. Right? Upgradation of account, very important. This is very important. So all these are new entries in the books, right? Examine all accounts upgraded from NPA to standard category, upgrade from NPA to standard back, going back during the year to ensure that upgrading of each account is strictly in terms of RBI guidelines. This is very important. A careful look has to be done. There can be a possibility of incorrect upgradation of account on the basis of partial recoveries made in the account, and overdue portion might not have been wiped out completely. There can be also a possibility of recoveries being made in the account after cutoff date and account being upgraded as on the balance sheet date. So, this is also possible. So, we have to look at all the accounts that have slipped into NPA. So, whatever we've discussed, right? We've discussed NPAs provisioning, we discussed SMA 1 and SMA 2 account, high risk accounts. we discussed about restructuring. We discussed that the accounts should be borrower wise and not facility. The NPA should be borrower wise and not facility wise. That also we discussed. And then we discussed about upgradation. Upgradation is very important because you are again saying that it is good. From bad you are saying it is good. So therefore this has to be having a careful look by the auditor. Now this is another purchase or sale of NPAs, where the banker wants to sell its NPAs to an asset management company who can recover it from this thing at a discounted rate, of course. In case of sale or purchase of an NPA by a bank, the auditor should examine the following: the policy laid down by the board of directors in this regard relating to the procedures, valuation and delegation of powers, including non-performing financial assets that may be purchased or sold, norms norms of such sale, purchase or sale, or valuation of procedure and accounting policy. Valuation, procedure and accounting policy. Only such NPA has been sold which has remained NPA in the books of the bank for at least 2 years. This is important, sir. This could be an important MCQ. At least 2 years. All the bold ones have been newly added. The assets have been sold or purchased without recourse. Now, factoring, if you remember, with recourse, without recourse, that is, the entire credit risk associated with the non-performing asset should be transferred to the purchasing bank. Okay, don't come back to me. Recourse now you come back to me. Without recourse you should not come back to me at all. Yeah, don't come. If there is any problem, don't come back to me. The entire credit risk, if I am selling the NPA and tomorrow you are not able to recover, don't come back to me. You have sold it at a discounted rate, that's all. With that it is over. So that is, everything has to be sold without recourse and not with recourse. So these are all important guidelines. 2 years at least it should be an NPA and without recourse. Subsequent to the sale of the NPA, the bank does not assume any legal, operational or any other type of risk relating to the sold NPAs. Of course, once sold, always sold. The NPA has been sold at cash basis only. I will give you shares. Non-cash consideration is not allowed. Under no circumstances NPA can be sold to another bank at a contingent price. It has to be a fixed price. So it has to be a cash based sale, it has to be a non-contingent sale. That is, if 50% is recovered, I will pay you 20% of that. No, nothing doing like that. It has to be sold at a fixed price. Okay, the entire sale consideration has to be received on upfront basis. Boss, this could be an important question in the examination because there are so many things here, right? The bank has not purchased an NPA which it had originally sold. Sale and lease back, nothing doing like that. I am selling and then again I am buying it back. Nothing like that. Okay, you cannot do all of that. This is on sale. In case of sale of an NPA, the auditor should also ensure that on the sale of the NPA, the sale have been removed from the books of the bank of selling bank on transfer. Of course. If the sale at a price below the net book value, that is the book less provisions held, the shortfall should be debited to the profit and loss account of that year. Of course, if I am selling it at a loss, say I have a net book value of 5 crores, I am selling it to the other bank at 2 crores, 3 crores should be booked as a loss. It is, if the sale value for a higher than the NB, that is at a profit, the excess provision shall not be reversed but will be utilized to meet the shortfall or loss on account of sale of other non-performing financial asset. So, if the sale is for a value higher than the net book value, okay, say the net book value is 5 crores but I am selling it at 7 crores. So I am getting 7 crores, that cash I am getting, that 2 crores extra money which is at a profit. The excess provision shall not be reversed. Okay, so you should not reverse it and book it as a profit, but it will be utilized to meet the shortfall or loss on account of sale of other non-performing financial assets. So you will have to utilize it to set off loss on other sale of other non-performing assets. You have to, don't take it to the P&L is what is the cash. Loss, immediately take it. Profit, don't take it. Keep it as a reserve. Keep it as a reserve which can be utilized for sale of other non-performing financial. You can utilize it over there. Right? So shall not be reversed but will utilized to meet the shortfall or loss on account of sale of other non-performing financial asset. Similarly, in case of purchase of NPA, the auditor should verify that the NPA purchase has been subjected to provisioning requirements appropriate to the classification status in the books of accounts of the purchasing bank. So the NBV should be correct, the net book value should be correct. and any recovery in respect of an NPA purchase from other bank is first adjusted against its acquisition cost only, and only the recovered amount in excess of the acquisition cost has been recognized as profit. So this is when I am purchasing the NPA, it's on the purchasing bank, right? Any recovery in respect of an NPA. So recovery is when I purchased it, say 5 crores. That is the purchase cost. Suppose I am able to recover the entire 5 crores, or I am able to recover say 8 crores. So in that 8 crores, first 5 crores should be against that this thing, and the remaining 3 crores has to be taken to profit and loss as a profit. Is first adjusted against its acquisition cost, and only the recovered amount in excess of the acquisition cost has been recognized as profit. For the purpose of capital adequacy, banks have assigned 100% risk weight to the NPAs purchased from other banks. This is very important. So I am sure you would have studied about this capital CRAR, right? CRAR ratio has to be calculated, right? So there will be total fund divided by funds, risk weighted funds. So the risk weighted funds, so for they will give you advances, depending upon the sector, and risk will be assigned 30%, 40%, 50%. For NPAs that have been bought by the purchasing bank, the risk assigned is 100%. That's what it is trying to say. Now again, I want to re-revise this entire provision again, so that it's consolidated, because it's a very important area, newly added area. It has to be, the policy has to be laid down by the board. The NPA cannot be sold if it's not an NPA, it should be an NPA for at least 2 years, and without recourse only you should sell. Okay, it has to be done on a cash basis only. It cannot be done on a contingent price. The payment has to be received upfront. You cannot buy an NPA which you have originally sold, right? In case of sale of an NPA, the auditor should ensure that the NPA is out of the books when it is sold. If it is less than the NBV, it has to be immediately recorded the loss has to be immediately recorded. If it is a profit, then you have to park it as a reserve and utilize it to meet the shortfall of other non-performing financial assets, right? In case of a purchase, you have to ensure that the NBV is correct and as per the classification status and as per the prudential norms given by the RBI. Once you recover the amount, it has to be in the acquisition cost that is there. Okay, the amount has to be first adjusted against the acquisition cost. The excess, if any, has to be taken to the profit, and 100% of the risk has to be assigned. 100% of the risk has to be assigned when you calculate your CRAR, your capital adequacy ratio. So yes, with this we complete we've completed one part of the, still it is not over, there are some additional parts that are there, but we've completed the major part, that is the advances, because the amendments in that area is major. With this one part of the, the amendments are done. So please go through, because in this chapter only there are so many amendments apart from what we have discussed. So please go through the study material to consolidate your understanding. So till then, take care and thank you. Let's take a short break of 15 minutes and meet after 15 minutes. Thank you.